welcome to class. Now let's take chapter 7 of this course of financial reporting. Now we have impairments of assets. This is discussed under the international accounting standard, okay, of the IASB, International Accounting Standard Board, IAS 36, impairment of assets. Now the objective of IAS 36, impairment of assets, the objective of IAS 36, impairment of assets, is to what? Is to ensure that assets are carried or are valued at what? Assets are valued in the financial statements at no more than their recoverable amount. In other words, the objective is that what? Assets should not be carried or recognized at what? At the higher of their at the what? Assets should be carried and valued at what? As their revalued amount, okay, which is the recoverable amount. Are we together? At what? At their recoverable amount. Is that clear? So now, okay, so having said that, hello, having said that, let's take the scope of what of IAS 36. IAS 36 applies to all assets with the following exemptions that are covered by other accounting standards. Okay, it exempts what? It exempts inventories. In fact, in short, any standard, okay, any standard that has been, or any transactions, okay, let's just take it that way. Any transactions that has been covered in what, in a particular standard separately or on a standalone, then will be what will be exempted, okay, will be exempted from what, from other standard, because in that standard the treatment, the measurement, the recognition would have been discussed, okay. So and so other, in order to avoid what, in order to avoid double treatment or conflict in what's in the treatment of such transactions, okay, so it's better to stick to what to stick to yeah, it's better to stick to one standard, okay. So now, such as what IS inventories, transactions of covering inventories has been discussed under IS2. Construction contracts, formerly it is IS 11, but now it has been covered by IFRS 15, okay. Revenue from contracts, okay, from contracts with customer, revenue from contracts with customer. Are we together? So we have also deferred tax. We have financial assets now, IFRS what? IFRS 9. We also have what? Investment property held at value, okay, IS 40. We have non-current assets classified as IFRS 5, okay. So all these are what? All these are exempted from what? From the treatment of impairments under IAS 36, okay. Are we together? Under what? Under IAS 36. We are not saying that those assets cannot be impaired, okay? But what we are saying is that what? IAS 36 itself, okay? IAS what? IAS 36 itself did not do what? Did not discuss, okay? Did not what? Did not discuss the aforementioned standards, okay? But it discussed what? It discussed impairment of what? Impairment of assets, okay. So inventory as an asset might be impaired, okay. Assets held for sale, non-current asset classified as held for sale might be impaired. Non-current asset itself, that is PPE, might be impaired. Investment property might be impaired and the likes, okay. When they are carrying, especially when they are carrying amount is what is less than what is less than when they are carrying amount exceeds their revalued amount. So in that case, we have what we know as revaluation loss, okay. We take them as what? We take them as a revaluation loss. Are we together? Okay. Now definition. The recoverable amount of an asset is defined as the higher of its fair value minus cost of disposal and its value in use. Okay, so recoverable amount is what? Is the higher of its fair value. Recoverable amount is the higher, okay, higher of its what? Of its fair value, less what? Less cost of disposal, and then value what? And value in use. Okay, so then what is fair value? Fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly manner between what? Between market participants at the measurement date. Okay, between what? Between the knowledgeable buyer and what? An knowledgeable seller at a what? At an arm's length transaction. Okay, so value in use is the present value of future cash flows from using an asset, including its eventual disposal. Value in use is the present value of what? Present value of future cash flows from using an asset, including its what? Including its eventual disposal. So if the income, okay, if the returns from the use of an asset for 5 years has been estimated to be what? 100 in year one, 200 in year two, 300 in year three, 400 in year four, and 500 in year five. So all these value, they are future or they are future cash flows. So they should be what? They should be discounted. Okay, it should be discounted using what? Using an interest rate or a discounting factor. Okay, or a discount factor, or what? Or effective interest rate and the likes. Okay, so you use them to what? To discount them to their present value. Okay, so for each year you do what? One plus the rate. Okay, one plus what? One plus the rate into bracket raised to power minus n, that's number of years. Okay, or you do what? You do 1 divided by 1 plus r bracket raised to power n. Okay, so is either you do the inverse method or you do this straight away. Are we together? So why impairment loss is what? Is the amount by which the carrying amount of an asset or a cash generating unit exceeds is what? Exceeds its recoverable what? Recoverable amount. So in other words, an asset is said to be impaired when what? When the carrying amount, when the carrying amount of an asset exceeds what? Exceeds its recoverable what? Recoverable amount. Are we together? Okay, so now what are the stages in accounting for an impairment loss? There are various stages in accounting for an impairment loss, and stage one is what? Is the establishment of whether there is an indication of impairment. So you should what? You should establish whether what? Whether there is what? There is an indication of what? Of impairment. Okay, so how do you know when there is what? If there is impairment? So if the number of production of a particular machine has been reduced drastically, okay, or is reducing production by production, then you know that such asset as what? Is there is being is impaired. Okay, is an indication that the asset is what? The asset is impairing. Are we together? Or if what? If there is a change in technology. Okay, so maybe this is how the way things are done now are different to how it is being done before. Okay, so then in that case you do what? You know, oh, this is an indication of what? This is an indication of that our current operation is being what? Is being impaired. So we have to what? We have to change the system and bring in new technologies. Are we together? So the stage two is that once an impairment has been noticed, or there is indication of impairment, then you should assess the recoverable amount. So how do we assess the recoverable amount? Is those what? Is just to take the higher of what? Of the fair value and what? Less cost to sell and what? And the value in use. Higher of what? Higher of fair value, less cost to sell and what? And value in use. Are we together? So then the stage three is to write down the affected asset by the amount of the impairment to its recoverable amount. So if the carrying amount is say 300,000 and the recoverable amount is what? The recoverable amount is 200. So the asset should be carried forward at what? At 200 and not what? And not 300. Are we together? The asset should be what? The asset should be write down to what? To 200 by the difference of what? By the difference of 100 naira. So the difference of this 100 naira is what? Is the impairment? What is the impairment amount? Are you getting it clear? Okay. So What are the indicators of impairment? Okay, now we have two types of indicators of impairment. We have the external indicator and the internal indicator. We have the external and the internal indicators. So what are the external indicators we have? When assessing whether there is an indication of impairment, IAS statistics requires that as a minimum the following sources are considered external sources. Now if there is a decline in asset market value, that's an indication to an impair to that asset. Okay, and also, if there is significant changes in technology, market, economic factors that have an adverse effect on the company. Now, mind you, all these indications they are out of control for the company. Okay, they are uncontrolled. They are external factors or they are factors that cannot be controlled by the company. Okay, so there is a decline in the asset market value. There's also changes in the technology. There's changes in market, consumer choices and the likes. So economic factors that have an adverse effect on the company. Are we together? So also an increase in interest rates affecting the value in use of the value in use of the asset. So if there's an increase in the interest rates of in the economy, okay, then what that will affect the value in use of the assets. Also, because it brings out the future cash flow estimates. Why discounting them to present value? It reduces it reduces the amount. You can compare a discount of 10% with that of 20%. Okay, so the present value for discount of 10% on the same future cash flows compared to 20% will be more greater than the present value of 20 or using 20% interest rate altogether. So also an indication is that when the company's net assets have a higher carrying value than the company's capital was than the company market capitalization. Okay, so let's take the internal sources or internal indications of impairment losses. One of the internal indications of impairment losses is when there is evidence that the asset is damaged or no longer of use to the entity. Okay, so if an asset got damaged, okay, or is no longer put to use for an entity, so such is what is an indication to that asset being impaired. Also, if there are plans to discontinue or restructure the operation for which the asset is used. Okay, so maybe formally what you use the asset to do is to produce goods that are worth 2,000 naira per product. Okay, so now the goods the machine cannot produce uh product worth 2,000 naira because of the impairment. Okay, now the goods it produced can only be sold in the market for 1,000 naira. So that means that it has been impaired. Okay, it has been because there is reduction in the quality of goods it produces. So also the type of the prices in which customers will be willing to pay for such type of quality goods or class of quality of goods is what is 1,000 and compared to at high quality which is 2,000. So this is what is an indication of the asset being impaired. Are we together? Or when you decide to change your line of business. Okay, and why will you change your line of business if not that the business has been has been generating a consistent losses? The returns are no more welcoming, they are not encouraging. So you decide to switch your line of business or to discontinue that operation, or you might decide to restructure your operation. So also if there is reduction in the assets expected remaining useful life, and there is evidence that the entity's expected performance is worse than expected. So in such case, there's an indication of impairment. Okay, are we together? Now we are progressing, right? Let's take our measurements or measuring recoverable amount. Measuring recoverable amount. It has been explained. Now, recoverable amount is what is the higher of our fair value less cost of disposal and its value in use. So if either of these amount is higher than the carrying value of the asset, there has been no impairment. So say for instance, the fair value of an asset is say 500,000 is what is 500,000, and the value in use is what the value in use is 400,000. Okay, and the cost of putting the asset to sale, okay, the estimated cost to sale is 150,000. Okay, So if you take out the 500,000 from 150,000, then you have what the fair you have it to be 350. Okay, so now 350 compared to the value in use, so you have what you have 400 as what as the recoverable amount. Now if the current amount of the asset is 300,000, if the current amount of the asset is 300,000, so therefore there has been no impairment. There has been no impairment because the recoverable amount is higher than what is higher than the carrying amount. So in this case, what you write down is what you write down is the recoverable is the recoverable amount is the recoverable amount, because what the law states is that what assets should not be carried as more than their recoverable or more than their recoverable amount. Assets should not be carried more than their recoverable amount. So in this case now, you have 400,000 to be written down as what as the carrying amount, the new carrying amount of the asset. Why the difference between the 300, which is the former carrying amount of the assets, with the 400,000, the recoverable amount is what is a gain. Okay, gain on evaluation, and such should be taken to P or L. Okay, to be recognized in what in the statement of profit or loss. Are we together? Okay, we are progressing, right? So now let's discuss the cash generating units. Cash generating units. IAS 36 defines the cash generating unit as the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. IAS 36 defines the cash generating unit as the smallest identifiable group of assets. Smallest identifiable group of assets that are largely independent. Take note the keyword that are largely independent of what independent independent of generating future cash flows, okay, from other assets or group of assets. Okay, so now what do you know by goodwill, or what do you have you had goodwill before? Now goodwill is also simply put is the good name is the good name of an individual, okay, or company. Okay, so it's what is the goodwill of what of is the good name, is the reputation of what of an individual or what or the company. So now the existence of cash generating units may be particularly relevant to goodwill acquired in a business combination. As discussed in our previous class, that you only recognize goodwill, which is an intangible asset, when they are being they are what they are acquired, and not when they are when they are when they are internally generated. Okay, so in this case we are saying that, oh, if this goodwill arise as a result of what as a result of business combination, okay, acquisition through business or acquisition through business combination, then the goodwill should be what should be relevant is relevant. Okay, now if allocation is not possible, that is if allocating impairment to goodwill is not possible, then the impairment review is carried out in two stages. Now you carry out an impairment review on each of the cash generating units. Okay, now you know you are discussing cash generating units, which is what a group of assets, or of which what each of these assets are independent of of generating cash flows. Okay, of generating cash flows to an entity. Are we together? To an entity. Now, independent of a group of assets. Are we together? So now we said that you can do this in two stages, as allocating impairment to cash generating units. If I was by carrying out impairment review on each of the cash generating units, excluding the goodwill, and recognize any impairment losses that have arisen, or you what carry out an impairment review for the entity as a whole, including the goodwill. So what you first do in the first instance is what you first charge impairment on goodwill, then the balance on the goodwill you prorate them on the other assets in that cash generating units, or you prorate you apply the impairment loss on the total cash generating units. Now how do you allocate an impairment loss to the assets of the cash generating unit? When an impairment loss arises on the cash generating unit, the impairment loss is allocated across the asset of the cash generating unit, in the following order. When an impairment loss arises on a cash generating unit, The impairment loss is allocated across the asset of the cash generating unit in the following order. First is to allocate to the goodwill, the cash generating unit. Allocate to goodwill first, then next is to what? Is to the other assets in the cash generating unit on a pro rata basis, that is in proportion to the carrying amount of the assets of the cash generating unit. Are we together? Okay, so without wasting much time, let's take disclosure requirements of the impairment losses. Sorry, impairment of assets. Yes. Now, for all impairments, the following disclosures should be made for each class of assets. First is the amount of impairment losses recognized in profit or loss for the period, and the line item in which those what the line item in which those items are included. Okay, and also similar information about reversals of impairment losses recognized in profit or loss for the period should also be disclosed, and the amount of impairment losses on revalued assets that have been recognized or reversed in other comprehensive income for the period and in the revaluation reserve. Also, companies are required to disclose the what if the recognition or reversal of an individual impairment loss is material to the financial statement. There should be what? There should be additional disclosure of one, the events that led to the recognition or reversal of the impairment loss; two, the amount of the impairment loss recognized or reversed; and three, the nature of the asset; four, whether the recoverable amount is fair value less cost of disposal or value in use, and how the figure for the recoverable amount was calculated was what was calculated. Is that clear to you? Okay, let me take that again. Disclosure requirement for impairment of assets. And one we have what an entity should disclose for each class of assets the amount of impairment loss, recognizing profit or loss for the period, and the line item in which those items are included. So if it is included in the what in the administrative cost, you should disclose that impairment loss has been recognized or included in the administrative cost is the impairment on what? On inventory, is the impairment on a machine, is the impairment on equipment. Okay, or if it is it has been recognized under distribution, maybe it is the motor vehicle or the delivery van that is being impaired. Okay, you recognize under distribution cost or distribution expenses. Okay, and if it is the machine that are used in the cost of production or in the cost of producing the goods the company trading that is being impaired, then you disclose that you include it in the cost of sales, and you disclose that impairment of asset has been included in the cost of sales to arrive at the gross profit for the year. Are we together? Am I making that sense? Okay, so now another disclosure is that similar information about reversals of impairment loss is recognized in profit or loss for the period. Now, if there's any reversal that is you have previously recognized a profit or an impairment, okay, on an asset in the previous year, and now there's a gain. Okay, there's a gain on the assets. Okay, so you have to now, mind you, impairment are not what you cannot recover impairment. Okay, once an asset has been impaired, it has been impaired. Okay, losses are not carried forward. Okay, losses are not carried forward. Are we together? So except if there's an information, okay, that you want to adjust for your prior year entries. Okay, there's an information that the time you recognize the impairment, there should have been the asset is not impaired, so and such should have not been recognized. So in that case, you have to reverse it and adjust for your financials. Are we together? Also, the amount of impairment losses on revalued assets that have been recognized or reversed in other comprehensive income for the period and the violation reserve should also be disclosed. And also, you are to disclose additionally the event that led to the recognition or reversal of the impairment loss, the amount of the impairment loss recognized or reversed, the nature of the assets, whether the recoverable amount is fair value less cost of disposal or value in use, and how the figure for the recoverable amount was calculated. Are we together? So now let's take a question on this, so as for us to get ourselves cleared, okay, and for you to have to appreciate what we've been taking you or what you have been taught. Are we together? Now I read the question. On 1st January year one, entity Q purchased 240,000 naira worth of machine with an estimated useful life of 20 years and an estimated zero residual value. Depreciation is on a straight line basis, and the asset had been revalued on 1st January year 3 to 250,000,
but with no change in useful life at the date. Okay, so on 1st January year 4, an impairment review showed the machine's recoverable amount to be 100,000 and its remaining useful life to be what? To be 10 years. Its remaining what? Its remaining useful life to be what? To be 10 years. Are we together? Okay. Now on 1st January, the entity purchased what? This is the cost, or let's take it at historical what? Historical cost. Okay. Historical cost, or what? Cost of the asset as at date of purchase, and we are told that it has an estimated useful life of what? Of 20 years. So 240 divided by 20, we have what? We have 12,000. Kindly punch your calculator to confirm that figure. And also we are told that depreciation is what? Is on a straight basis, of which we have done that year without what? Okay, taking note that the asset has no residual value, so that's why we have it here straight. That didn't mean it has a residual value of say 200,000 or 40,000. It should have been what? It should have been what? 200,000 after taking out the 40,000 for residual value divided by 20, of which we arrive at 10,000 naira as what are the depreciation that will be charged or chargeable for each year. Are we together? Now the asset has been revalued on 1st January year 3, that is after 2 years of acquisition, from acquisition of the asset to what? To 250,000, but with no change in the useful life as at that date. So now to get that right, okay, even though we have not finished reading the question, but it's good this way. While reading the question, you analyze, so that, and in fact I will urge you that in your exam, kindly first check on the requirement of the question, so that will give you a clear picture of where you are going. Okay, it give you a direction of the examiner of what the examiner is asking you, and while you come back to the body of the question, okay, then reading through the question, you have a clear understanding. In fact, you have it direct at your hand or at your palm what the examiner is asking you to do. You get the mind of the examiner, and with that you'll be able to put some valuable things down all together. So there's revaluation. So now the depreciation from that day to from year 1 to year 2 is what? Is 12,000 multiplied by 2, isn't it? So that's 24,000. So carrying amount as this date will be what? Okay, let's leave it that way first. And we are told that on 1st January year 4, an impairment review showed the machine's recoverable amount to be 100,000 and its remaining useful life to be 10 years. Now the recoverable amount is now 100,000. Okay, and we are told that its estimated useful life from this date is now 10 years. So depreciation value at the end of year 4 will be 10,000 naira. Depreciation will be 10,000 naira. Now to determine the impairment loss or impairment gain, sorry, there's nothing like impairment gain. To determine if there is impairment loss or there's a revaluation gain. Now we need to let's check on the requirements to know the mind of the examiner. Know what the examiner is asking us. Now first we are required to calculate the current amount of the machine on 31st December year 2, and hence the revaluation surplus arising on 1st January year 3. And also we have to calculate the current amount of the machine on 31st December year 3 immediately before the impairment. And also we have to calculate the impairment loss recognized in the year to 31st December year 4 and the depreciation charge in the year to 31st December year 4. Now without wasting much of our time, let's do this in quick time. Okay, our suggested solution. Suggested solution. Suggested solution. Now first we have the name of the entity is not given. Okay, so let's just use entity A, and then we have our cost. Okay, cost at 1st January year 1. Okay, we have that to be 240,000. Okay, so less accumulated depreciation to date to 31st, okay, December year 2. Kindly please don't abbreviate while you are in the exam. Okay, so the accumulated depreciation can be calculated alternatively by saying 240,000 divided by 20 years multiplied by the number of years in use. Okay, so that's 2 years, and then we have 24,000 So this we have what? We have a balance of 216,000. Okay, we have what? We have 216,000. So this is what? This is our carrying amount at the end of year 2. Okay, so if this is the carrying amount at the end of year 2, we are told in the question that what? Hence the evaluation surplus arising on 1st January year 3. So on 1st January year 3, what's the value of the asset? The value of the asset is 250,000. Okay, uh valuation value of the asset at 1st January year 3, we have 250,000. Okay, if we take this out of this, we have 34,000. We have 34,000. So this 34,000 is what? Is our valuation was 34,000 revaluation gain. 34,000 is what? 34,000 is our revaluation. What is our revaluation gain? Are we together? So revaluation gain at 1st January year 3. Okay, so now also that's question A or 1, and B, we have to prepare what the carrying amount of the machine on 31st December year 3. Carrying amount of the machine on 31st December year 3. Okay, B, carrying amount on 31st December year 3. Sorry, on 31st December year 3. So we have what? We have uh, carrying amount as at 1st January 2013. We have 250,000. Okay, so less depreciation during the year, less depreciation during the year. Èló year, we have 250,000. Okay, so we are told that the as at 1st January 2013 and third year, the useful life remain same. So and 2 has gone already, so we have 18 months left. Okay, so you do 250 divided by 18 months multiplied by 1. Okay, so that you have what? You have 13,888. Okay, approximately 13,890. Okay, so we have a balance of 110 and 236, right? Okay, so 110 and 2 what? 110 and 236. So these are what? These are our carrying amounts at the end of what? Of year 3. Are we together? Okay, so what's the question still asking us? Are the impairments loss recognized in the year to 31st December year 4? So what's the value of year 4? The recoverable amount is what? Is 100,000. And what's our impairment? He said impairment is defined as what? As the difference in the when the carrying amount of an asset exceeds its recoverable amount. Okay, impairment loss at the start of year 4. Okay, so impairment is what? Is the uh is when the carrying amount of an asset
exceeds is greater than what exceeds the what the greater than the what than the recoverable amount. Okay, so we have our carrying amount as at 31st December year 3 to be what to be 236 110. Okay, we have our recoverable amount as at 1st January year 4, we have 100,000. Okay, so the difference is what the difference is 136 110. Okay, so this is what this will be our impairment loss for at for impairment loss for us as at 1st January year 4. Okay, so as at 1st January year 4. And question D is asking us to prepare the depreciation charge in the year to 31st December year 4. Okay, so depreciation charge during year 4. Okay, so we have what we are told that the assets are in useful life is what is 10 years. Okay, so we have what cost minus scrap value, and we are not told that it has any scrap value. Okay, all about estimated useful life. Okay, so we have what we have the carrying amount. Okay, the carrying amount is the recoverable amount now is 100,000 divided by the remaining useful life, which is what which is 10 years. We have what we have 10,000 here as the new depreciation amounts. Are we together? Okay, so we are progressing, right? Oh, sorry, we have come to the end of this chapter, the end of this class. I wish you a very successful diet ahead, and I urge you to always listen to this video lecture to get it clear and to get it right, so as to what to help you perform well in the coming examination. Goodbye.